In 1929, Joseph Kennedy stepped aside months before the break and made a fortune shorting the slide. 2008, Michael Burry bet against subprime and walked away with hundreds of millions. In 2025, the rhyme is unmistakable. Same 4 stages, same investor archetypes, same choreography. What's different is who's actually watching it happen. There's a recurring script in market history whenever valuations go to extremes. It isn't luck. It isn't magic. It's a 4-step sequence that disciplined capital runs like clockwork. While the public clings to positions all the way down, a small cohort sets up to harvest the bust. They don't trigger crashes. They recognize the setup and place chips where gravity does the work. It happened in 1929 with Kennedy exiting highs and riding the downside. It happened in 2008 with Burry, John Paulson, and others shorting the housing edifice. And the posture today rhymes with both. Warren Buffett is sitting on an unprecedented cash mountain, hundreds of billions. Jeff Bezos has sold over 13 of Amazon. Mark Zuckerberg has unloaded billions of Meta. Insider selling across the C-suite echoes 2007. Select funds are building payoffs that only work if risk assets break. That's not a theory. It's observable positioning. The pattern is historical record. Once you grasp the 4 stages, you see exactly where we sit. We're deep in stage 3, setting up for stage 4, where cash buys the world at clearance. Stage 1, exit 12 to 18 months before the fall. Savvy players lighten up while prices still rise, not because they know the day and hour, but because risk-reward has flipped and leverage is brittle. In 1929, Kennedy, veteran of the Roaring '20s stock pools, started distributing into strength. The shoeshine tip story is cute. The real driver was his understanding of margin, with investors borrowing up to 90% of purchase value. A routine 10% drop would force liquidations and cascade selling. Bernard Baruch read the same tea leaves from prior panics. By September 1929, both were largely in cash. The Dow topped September 3rd at 381. 7 weeks later came Black Thursday. They had already moved. In 2005-06, the pattern resurfaced with new instruments. Michael Burry, running Scion, tore into loan-level data and found a landfill of teaser arms, no doc stated income, and resets borrowers could never meet, yet magically stamped 8AA. You couldn't short MBS directly, so he helped banks craft credit default swaps on those bonds, insurance that pays when the bonds fail. He paid premiums, bled carry, and endured investor revolt. John Paulson reached the same conclusion and launched dedicated short funds. That was stage 1 in practice. Leave the party. Early and build asymmetric downside. Now scan. 2024-25 Buffett's shareholder letter boiled down to nothing priced. Tractively. Translation: upside thin, downside fat. Bezos and Zuckerberg sold size, not token diversification. Jamie Dimon even trimmed. Insider selling is at cycle highs. The Buffett indicator, market cap to GDP, hovers 185%. Far above the danger zone Buffett himself once cited near 120%. The message isn't subtle. Stage 1, largely done. Stage 2, buy volatility insurance 6 to 12 months ahead. Exiting isn't enough. Protection is cheapest before fear shows up. That means puts, VIX calls, or credit protection. Vehicles that explode if the floor gives way. In 1929, the analog was short stock borrowed into strength. Carry costs hurt until the air pocket arrived. Then the math inverted. After October, falls of 30%, then 50%, then an 89% drawdown into 1932, turned shorts into windfalls. In 2005-07, Burry and Paulson's CDS premia, 4% per year, looked dumb right up until they looked genius. When defaults rose, Bear Stearns imploded, and Lehman vanished. Those swaps paid hundreds of millions to billions. Bill Ackman ran the 2020 speedrun. 27er in credit protection turned into roughly 2.6 BSIRs during the COVID panic, then rotated into beaten-down equities, insurance into ammo. Look around 2025. Put-call ratios have stayed elevated. Institutions are leaning into hedges. Sizable VIX call blocks sit out in mid-late 2025 expiries. Credit protection on commercial mortgage-backed securities has repriced violently higher. Someone is paying fat premia because the arithmetic on vacancies, refis, and cash flows says, pay now, get paid later. Public comments from big funds about hedging CRE and regional bank risk suggest similar setups. Stage 2 underway. Stage 3. Short the weakest links 3 or 6 months before the break. This is surgical. Don't short everything. Short what structurally cannot withstand the new regime. In 2007-08, Burry and Paulson targeted the worst tranches. Geographies with wild speculation. Arms hitting reset windows, bonds most sensitive to early delinquencies. Paulson then pressed shorts in institutions with toxic exposure. Bear, Lehman, WAMU. Despite consensus, buy ratings and too big to fail complacency. Insolvency is a math problem, not a vibes problem. Today's red zones, commercial real estate, and the regional banks tied to it. Office utilization is permanently lower. Mortgages written at 3% are meeting refi walls at 7 to 9%. NOI can't service the new debt. Values are down 40-60% in soft markets. When the equity is gone and cash flows don't pencil, rational owners mail the keys. We've already seen trophy defaults and voluntary surrenders. Over 2 total and commercial maturities run through 2025-26. The lenders most exposed are regionals with 20-40% CRE loan books. As losses flow through capital, closures cluster. Short interest has swelled in the obvious names. This isn't rumor mongering. It's balance sheet triage. Stage 3, active. Stage 4, buy at maximum fear. This is the payoff. You need cash from Stage 1, optionality from Stage 2, and convictions from your prep list. You pull the trigger when it feels worst. In the Depression, the market slid 89% peak to trough. Kennedy and peers amassed real estate, operating businesses, and equities at prices below net cash. That's where dynastic fortunes compound. In 2009, the S&P bottomed at 666. Buffett cut preferred plus warrants deals with Goldman and, later, Bank of America. Double-digit coupons plus equity upside. Then scaled quality names across financials and staples for 3x returns over the cycle. 2020. Ackman turned his hedge payout into stakes in durable brands before the policy bazooka ignited the fastest recovery on record. Project that forward. The catalyst could be CRE default snowballing, a mega-cap tech derating, a geopolitical shock, pick your spark. 50-60% drawdown isn't an outlier if the unwind runs hot. Unemployment spikes. Banks wobble in clusters. News cycles scream collapse and policymakers scramble. That is when the cash hordes move. Berkshire's war chest is not for show. It's a staging area for preferreds, warrants, outright buys, and whole company takeouts at terms only liquidity providers can demand in a funding drought. Private equity dry powder. Apollo, KKR, Blackstone, Carlyle. Waits for $1 assets at 0.30, 0.50. From towers to distressed debt to foreclosed resi. They'll season those assets 5 to 10 years and exit into normalized multiples. The mechanism repeats because human behavior repeats. Leverage inflates, risk is mispriced, a shock reveals the mismatch, and forced sellers create mispricings for prepared buyers. Across a century, the same 4 stages have delivered outsized gains to the few who execute them end to end. Zoom in on now. Stage 1 largely done. Insiders sold, mega-cap founders trimmed, cash stashed. Stage 2. Ongoing, hedges are on while vol is still affordable. Stage 3. In motion. Precision shorts in CRE and the regionals most exposed. Stage 4. Waiting for the bell. Signals stack up, a deeply inverted then re-steepening curve that has preceded every U.S. recession since mid-century. A market cap to GDP ratio near prior danger zones. Rolling CRE stress. Regional bank fragility. Insider sales reminiscent of '07. If you can't run the institutional 4-step, you can still think in the same framework. Extra cash and T-bills. Thoughtful finite hedges dated 6 to 12 months out. And most crucial, your buy list pre-built. Durable cash generators with low leverage and must-have products you'll grab when they're marked down 50-60%. The emotion at the bottom will scream, "Wait, history whispers act, we've seen the play twice in the modern era. 1929 and 2008 and a compressed version in 2020, the rhyme today is loud. Stage 4 is the wealth transfer point. Whether you arrive with dry powder and a plan, or arrive with hope and no capital, decides which side of that transfer you're on. The pattern is public. The clock is running. At Frostline Economics, we track the sequence. Right now, it reads late stage 3, countdown engaged. This is Frostline Economics, no BS money moves. Like and subscribe. Drop your zip. I'll pin the exact free file plus Vita links for your area tonight.